Thank you, everyone. Well, my pleasure to be in this FXStreet trading seminar. It's a true pleasure being my first time in this amazing community. So thank you for welcoming me in this room. So today the trading seminar is about do's and don'ts in trading. I'll go over certain material which is, in my mind, critical for traders or investors as well, of course. And as you can see on the bottom left of the screen, on the bottom right of the screen, there is my email address and my name as well. We will have for sure a Q&A session at the end in case you have any question. And also please feel free to type your questions in the chat box as we conduct the session. I'll be taking a look at those questions, and if possible, I will answer as you type them. If not, we'll answer those questions at the end. But also, if you were to have questions beyond what we covered today as well, I'll be delighted to receive your emails with questions too. So anyway, before we begin, a quick introduction. I'll keep it short because really this training is about you. No, it's not about me. But I guess it's also important for you to understand who is the person behind the voice. So my name is Jose Blasco. I will be your guide in today's session. I am a multi-asset trader. I trade short-term, long-term, intermediate-term, all styles of trading, all assets, as I said. Could be options, could be forex, could be futures, could be commodities, could be stocks, directional trading, non-directional trading. Really, the financial markets, it's a big passion I have, and I do exploit this amazing instrument in different ways. Okay, when it comes to education, well, I've always loved educating. I happened to be a university professor many years ago, and the day I got into trading, well, that's what I do exclusively, and the financial markets is my life. Okay, but educating, obviously, it's a passion I have too, and this is one of the reasons why I am here with you today, which is again a pleasure. Also, before we start, as always in financial presentations, we have disclaimers, so I will go over disclaimers very quickly. The following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. And as a user, you understand and agree that hypothetical results obtained through the demonstration do not indicate in any way the results you may receive from using our products, which is our disclaimer. Okay, so today's session, it's about you. And let me explain what that means, because in one hand it's obvious, but in the other hand, it has many implications. Think about this. What I mean with the session is about you is that it's quite common that traders attempt to improve their trading results by improving their methodologies, which on one hand, it makes sense. But the fact is that putting on the side that there may be room for improvement with certain methodologies themselves, putting that on the side, there are many aspects of trading that are often overlooked, creating dangers that may not have been noticed. And sometimes traders fall into problematic situations just because we don't know what we don't know. Is that making sense? So today's session, talking about do's and don'ts, is a session that will apply to all of us, all of you. And no matter how you trade, what do you trade, what is your style, long-term or short-term, which currencies, and even no matter the methodologies that you utilize as well, we're going to be talking about very healthy practices on how to trade, and also very dangerous things that could be done and how to avoid them. Okay, so let's begin. We're going to start with the do's and don'ts, and since it's going to be our first do's and don'ts number one, I would like to first talk a little bit about the structure on how I'm going to present the content to you. So you follow the structure. It's going to be a 4-step structure. So what we'll do first is to talk about facts. Okay, so if I present a do or a don't, we look at the facts behind it. From the facts, we will move into the dangers that those facts imply, because it's all about keeping you safe, isn't it? Trading is all about managing your risk, being on the safe side, and this is how our accounts have potential to grow. If we were to hurt our trading accounts, then it doesn't matter how many markets we trade, how many trades per day we take. None of these matters, because we end up in trouble because we are not keeping ourselves and our accounts safe. Okay, so we'll talk about number one, facts. From then we'll talk about the dangers involved related to those facts. Number three, we will explore the solution, which is how we take care of that. That's going to be the do instead of the don't. And then number four, that probably is going to be the most important part of all, which is when we look at specific examples with charts and specific market situations that happened, and we will be able to understand those do's and don'ts apply to real-time market conditions, okay? Which is going to be the key for you to really kind of digest the information I plan to share with you, so you can begin the process of internalizing it and take it to the next level, okay? Because also I understand in the group, probably some of you are very experienced traders, where some of you may be in the beginning part or the beginning process of learning how to trade, or anywhere in between. If you happen to be very experienced, it's going to be very healthy to review things that are basic and foundational, but they are critical, because today is a basic lesson. We will go over advanced lessons too, but today we start with a basic one. So this foundational lesson is going to be very healthy for advanced traders to review the basics, and it's going to be critical for the new traders to begin their process of learning how to trade in a way that is stable and safe, okay? And for the ones in the middle of the process, well, obviously it's going to be healthy too. So finally, before I begin with the first do's and don'ts, there is one more comment I want to make, which is, of course, everybody here in the group may have a different methodology on how to trade. So what I will do in this presentation is I'm just going to use when I use examples with charts, I will use a very simple app that shows green when it's time to buy and shows red when it's time to sell. Okay, and I'm gonna use this app because it's gonna be very visual, very simple to understand, and then in your specific cases, you would want to visualize when I give you the examples using the red and the green. You will want to visualize, with your own trading methodology, how does that look like? And then you would be able to apply the same do's and don'ts to yourself based on whatever your trading methods are. Okay, but since we are a large and diverse group, I will be using a very simple approach to trading, and as you will see that in the first example with the green and the red. Okay, again, green for buy, red for sell, which is kind of common sense. So let's begin. Okay, let's begin. Up to this point, we've been introducing the session, so we are well organized, and now it's time to dive in. So first, do's and don'ts. Don't be rigid. Instead, be adaptable. What does that mean? So let's look at the facts. It is almost impossible not to have personal views when observing the financial markets or the economy. What's the danger then? Well, the danger is that we like to be right on our views. We like to be right on our views and our preferences, which could easily create a bias towards trading decisions, ignoring the reality when maybe it's not even time to trade at all. Maybe you are biased to go long only, biased to go short only, just because of our views. And it's almost impossible not to have personal views because we're human people, isn't it? So what's the solution to avoid this biased approach to trading? Well, the solution is to use discipline. Use discipline when applying your trading methodology, where every decision in that trading methodology, every decision and action needs to be based exclusively on objective and mechanical rules. So notice the two keywords here, objective and mechanical. Let's look at an example to understand this better. So here's an example where we have a chart of the Great British Pound in a 15-minute time frame. In the examples I will be giving you, you will be able to see the symbol that is a little bit of a watermark in the background of the chart, and also the number next to it is the time frame. So in this case, we are looking at the Great British Pound in a 15-minute time frame, and as you can see, here is the green that I was mentioning, and here's the red that I was mentioning. So based on this particular app, again, it could be any other trading methodology. The below price is the price at which you want to buy, and the upper price is the price at which you want to sell. So now, at the moment in time, really, if you look at the price action for the Great British Pound, not much is happening, and this is because the market participants is waiting for some sort of a news to be reported. So the news is reported, and take a look at the news. The news says that the UK Prime Minister May is set to announce a timetable for her resignation. Of course, this will create biased beliefs, opinions, preferences, because we're human. Some people will choose to think about this news like it's a good thing and the pound will go up. Some people will choose to look at this news like it's a bad thing and the pound will go down. And again, we don't know what's right or what's wrong, but certainly it's almost impossible to not to have that view. So the news is released at 8:58 a.m. GMT. Let's say you were to be a trader where you could only imagine the pound to fall. Let's say that's your bias, okay? And this is, again, just an example. So what would you do? Well, probably you would want to short, and that's it, okay? But again, the two key words that we covered earlier were the word objective and mechanical. So what's objective, okay, is that there are on-field orders to buy in the green area based on this trading methodology, and there are on-field orders to sell in the red area based on this trading methodology. So the right action to be taken, okay, would be to buy when it goes in the green and sell when it goes in the red, no matter, if you wish, what the news is. Instead of allowing the news to bias us to short only, a much better approach to trading would be to be objective, to use rules. That would make you mechanical. And if you were to use the magic discipline, so now those rules applied with discipline becomes consistent action, and consistent action produces consistent results. Where if every time you see a news, you were to have a particular interpretation of the news, which is normal and it's human, next thing you know, you may, depending on probably factors such as luck, you may end up producing variable or random action, which probably produces random results. So very simple thought. And the fact is that in the end, what happened to the pound is that it went up, okay? And, you know, if you were to be this particular trader, the one that had that particular opinion, then you got hurt. Is that making sense? Again, because the trade was based on the rigidity of our own views, and because it's our views, you know, we kind of get attached to it, and that's it, and we trade based on that attachment. Okay, so we need to learn to detach ourselves from those rigid views that we all have, sometimes unconsciously, and be adaptable and trade on a mechanical way based on following rules with impeccable professional discipline. This will be the sign of a professional trader, and the before statement would be the sign of an I would say maybe uneducated or less educated or less professional, maybe an amateur trader. Okay. Good. So let's go for do's and don'ts number 2. So the number 2 says that don't be idealistic. Instead of being idealistic, have a quantifiable edge. Now, what does that mean? Again, let's look at the facts. We often favor certain markets and reject others simply based on our own beliefs, preferences, or prior trading experiences. Maybe you are European and you rather trade the euro long because you are European. Maybe you are a Japanese person and you rather trade the yen long instead of short, just because you love your country and therefore you have this unconscious belief or unconscious attachment for your currency. This is, again, just an example, but certainly it happens. So what's the danger of doing that? Well, we lose objectivity. We lose objectivity when trading those preferred markets, as we are convinced that our choice is enough to increase our probabilities of success. Right? It's like in life, and obviously trading is no different. The moment you have a choice, that choice belongs to you, so you justify it to yourself, consciously and sometimes unconsciously too. And if the choice is not the right one, then it's problematic. But there is a lot of negation for that particular behavior. Okay, maybe you purchased an article that you didn't need, but you negate that fact just because, you know, it was your choice, you know. So these things happen in life, it happens in trading too. So how do we solve this problem? What's the solution? Well, use a methodology with reasonable statistical performance results and back test it to accelerate the speed at which it becomes your second nature. Well, there are multiple concepts here in the solution, but the one word I would like to highlight is the word backtest. Okay, so what is backtest? Backtest means don't trade a market in a way, or don't trade a market that you choose just because you think it's a good idea. Forget about good ideas. Instead of being idealistic with a certain idea, go ahead and backtest whatever idea you had to see if that idea produces a measurable, quantifiable edge or not. And the ideal way on how to backtest is to use a market replay technology. Some platforms out there, okay, you can do it manually as well by scrolling a chart to the left and without cheating, not looking right. But ideally, you use a market replay technology in a platform, and you can go back in time and see what happens when you apply a certain methodology and take samples. So for example, in this case, we have, again, same chart as before, is the Great British Pound in a 50-minute time frame. We have red, okay? So we have red in here, which means that if the pound was to ever come to here, the expectation would be for the pound to fall, okay? That would be the expectation. So you could use market replay technology to plan the trade and then click play and see what happened. And when you click play, you can see that it came into the red and it dropped down. So you would congratulate yourself and you would say, good one. So what would you do now? You would log it. You would get a spreadsheet or any other piece of technology, or if you don't like technology, a piece of paper if you wish, and you would just make a note. And you would keep doing that. You would keep sampling your trading methodology. For example, now on the right, we have another opportunity with the same pound, where now what we have is we have green. So if the pound comes to the green, the expectation would be to have it go back up. Okay, so let's see what happened. We planned the trade to go long there, and then, oh, that one didn't work. Okay, it went down and it kept going down. So what do you do when this happens? The trade failed, you log it, and you would go over a collection of trades. Statistical experts, statisticians, mathematicians would suggest that a minimum of 30 samples would be needed. And of course, more than 30 is better. And as you have collected those samples, now you will know what to expect from your methodology, and you will know if you have a quantifiable edge or not, because you can measure the statistical results of your trading methodology instead of trade the pound just because you like the pound. We need to make sure that what we do in trading produces that quantifiable edge. Okay, it's very common, for example, to maybe purchase a trading book. I'm just going to use a random example here. Maybe the trading book was explaining a little bit of market analysis, technical analysis, and maybe in that book you learn about head and shoulders. And now, because you know about head and shoulders, you go ahead and you begin trading head and shoulders. Well, instead of doing that, what you should do is don't be idealistic with the head and shoulders. What you should do is go ahead, rewind the market, use market replay technology, and look for head and shoulders, and then click play and see what happened and log it. And get to see if you do have a quantifiable edge trading head and shoulders in whatever market that you trade, in whatever time frame that you choose. And if the answer is yes, then congratulations, you have an edge, and now you have odds of success. Because if you don't, and you were to trade the head and shoulders or whatever other technique without going through a backtesting process, basically you are hoping for the best, which is a little too idealistic. Okay, and again, sometimes, by the way, some of the things that I will say in this presentation may be some of the mistakes that some of you have made, and sometimes, funnily enough, sometimes we, in everything in life, including trading, sometimes we make mistakes out of a very good intention. Maybe what you wanted to do is that you wanted to practice, to develop your skill, and you had a great intention and you put time and effort to do it. But next thing you know, you did it without going back in time and really understanding what type of tool you have in your hands. Do you have an edge or you don't? Okay, so it's very, very important for you to quantify in this case. Do and don'ts number 3. Okay, do and don'ts number 3. Don't guess. Okay? Instead, act based on evidence. So what does that mean? So let's look at the facts. It is common that our subconscious mind triggers our imagination to work autonomously in a way where involuntary market predictions are made. What's the danger? Well, often these predictions have a lot to do with what we want, which is our desires, such as large moves, distant targets, and so on. And this would be subjective and would fall into what we call wishful thinking. For example, you like very much, I'm just going to use a stock, for example, even though most of the example will be currencies, but in this case, if you don't mind, I will use a stock example. So let's say you love Apple products, you like very much the products made by Apple as a company, you love their technology, and let's say you are looking at their stock. So not only you like that company, let's say you actually own shares of that stock. So what could happen subconsciously in a way that is involuntary and autonomous in your subconscious mind? What could happen? Could happen that you envision Apple to break out and go to the moon. And again, these predictions, okay, may have a lot to do with what you wish instead of what it is. I mean, you wish that. Why? Because you are invested in Apple, and why? Because you like that company. So again, it's not based on evidence. It's a guess. Okay, it's a guess, and by definition, a guess will carry lesser probability. Therefore, it would be better to use evidence. Okay, so what's the solution? Use techniques and tools that look behind the scenes, scanning for signs and traces that reveal the existence of large market players. I mean, think about it. If you are guessing or predicting a movie is going to happen, which we should not do that, think about, let's rewind and go back, and let's think about what is the only cause that in the end will be the one cause that produces a market movement. Well, the only cause is that the large market players are causing the movement themselves, because they are the ones who have the needed size to be able to produce market movements. Retail traders or investors, smaller traders, don't have the power to move a market, but the the large market players do. So what should you do instead of guessing is to look for evidence that proves that those large market players are in the market right now as we speak. And as you get that evidence, then you would then act on it to plan on a trade based on that evidence instead of a guess. Okay, so let me give you an example. So here's an example with the US dollar, Japanese yen. Again, just to create a little bit of diversity on the examples, I'm using a 60-minute time frame here in this example. And what do we have? Well, we have a trend going up. So at that moment in time, the Japanese yen is moving up, and there is a certain news about to be reported by the Bank of Japan. So the news is reported, and the news is no surprises. So no changes, no surprises. So again, similar to an example that we saw earlier with Theresa May, the news in this case, even though it's no surprises, we still create some sort of a belief, an unconscious belief, a guess, a prediction. In this case, since the news wasn't changed, let's say that there is a whatever amount of quantity of market participants that may guess that, you know what, since nothing has changed and the trend is up, so then the trend is likely to continue being up. So what do? You want to buy, okay? Well, that would be acting on a guess. Instead, it would be better to, again, going back to your trading methodology, whatever it is. In this presentation, as you know, I am using the green zones and the red zones. So what you would do is, as you can see, the news was being reported at this moment in time on the chart. Okay, this moment in time on the chart was here, and what the news created is a drop, right? So now I have the evidence. Now I know what the news mean, right? So what would I do? I would not try to jump on board late to the party. I would just now wait patiently for the market to come back to where the red is, which is my selling point, and then let the market fall until it gets to the green, which is my buying point. And that would be my opportunity to short based on evidence. And sure thing, sorry for that, guys. I just clicked in the wrong button. And sure thing, you could have entered the trade at this particular time, which is what I was pointing at. And from there, the yen dropped until it got to the green, which would be the time to take the profit. So this would be an example of entering short based on evidence instead of having a subconscious prediction out of an opinion or subjective pieces of information, which obviously will lead to be depending on how lucky you are, which obviously I mean, millions of people do that, but it's not the way to do it. I mean, professionals, we don't do that. Okay. So number 4, don't be low tech. Instead, use advanced trading technology. What does that mean? Well, the fact is that most markets around the world became electronically traded in the 90s. That's like 30 years ago. And large market participants use powerful technology to execute all their trades. So what's the danger? Well, the danger is that most non-professional traders use trading techniques that imply too many manual tasks that are tedious and time-consuming, creating a clear disadvantage when competing against machines. Like, for example, going back to my prior example of looking for head and shoulders, there is nothing wrong with looking for head and shoulders, but if you do this manually, not only is tedious, it's actually subjective, and now you change time frames and you don't see the head and shoulder that you saw in a different time frame. And basically, it puts you in a position where it's very difficult to compete against machines that have an edge, which is quantifiable, that execute at the speed of the light. And on top of that, those machines belong to the big market players, the large market players that have the power to move the market. So we cannot compete against them, like it would have been done in the 60s by using, let's call it, manual techniques. We need to be a little more advanced when it comes to the use of trading technology. And by the way, that's a piece of cake nowadays. There are many, many options and tools out there that could be used efficiently. Okay, so solution: use modern trading technology that focuses on spotting trading activity produced by those large computers and leverage on it to plan your trades. So in other words, instead of you buy at the price you would like just because you would like, because you happen to like the Japanese yen, for instance, you will want to use trading technology that looks for evidence, looking for those large market players. And when your trading technology identify that out of evidence, those large market players are entering the market long or short. So what do you do? What you do is very simple. You just tend to replicate what they do. When they buy, you buy. When they sell, you sell. And this will make your life much more easy. And much more importantly, now you have an edge. Now you can produce continuous, consistent action in the marketplace to collect continuous, consistent results and returns from the marketplace, instead of subjective, tedious, time-consuming, guessing type of trading activity, which is, again, I repeat myself, in this group, many of you are very experienced traders, and I'm sure that you are not doing that. But at the same time, I would say, and please feel free to comment on the chat box if you wish, I would guess that even if you happen to be very experienced, okay, I would guess that many of you in early stages of your learning, maybe you made some of those mistakes. I mean, I did when I was learning many times because of a good intention, just because maybe I wanted to practice, I wanted to see, I wanted to test. But the reality is that I was not following a process that was 100% defined, structured, rule-based, etc., etc. Okay, so it's very, very important to surround ourselves from those tools, because that is the difference between acting to reach success versus acting to just be in trouble. Okay, so example. So here's, for example, a collection of currency pairs. Okay, imagine yourself looking and analyzing and researching for trading opportunities manually on all those different currency pairs: the Australian dollar CAD, the Australian dollar Swiss franc, the Swiss franc yen, the Euro Sing dollar, the New Zealand Japanese yen, the New Zealand CAD, the US dollar Mexican peso, the US dollar Hong Kong dollar, the US dollar Canadian dollar. I mean, there are so many, right? So if you were to do all of these manually, maybe in the end, the other thing that may happen is that after looking at 5 charts, you kind of got tired and impatient for looking for trades. And anything that may look like a trade, you just take it like it's a trade, even though it may not fulfill 100% all your trading rules. Okay, so it's important to use trading technology, such as, for example, market scanners, right? Where now powerful scanners could be, basically analyzing the markets for you and filtering out undesirable characteristics from some markets that you don't want to trade. So what's the beauty of doing things like that? Well, first, you are not wasting your time. You only look at charts of markets that your scan approved. Therefore, because when I mean undesirable characteristics, what I mean is that markets, for example, let's say a market is not in a clear trending condition, or a market is not in a situation where there is much room for a profit. So looking at that chart is basically you wasting some time. Where if the scan was to filter out those undesirable characteristics markets, next thing you know, you have a list of 5, 10, whatever markets to be checked. And now, you save a lot of time. And most importantly, you are dealing with markets that may, by themselves already, thanks to the filtering process, may have an advantage for you to trade them. And you ignore the markets that don't have that advantage. Okay? Then you can also use trading apps, could be trading indicators, etc., that could help you as well to time your trades, to identify better when to buy, when to sell, etc. Okay. Paul, we have all made all the mistakes to get where we are and breaking the rules before learning. Patience and discipline. Yes, and so appreciated that you are typing this, Paul, because this is the path, and in life sometimes it's like many things. Sometimes we actually need to make some of the mistakes, so those mistakes really sink in and we really learn the lesson. Because sometimes, like today, where I'm sharing with you a theoretical lesson, well, hopefully you are appreciating the content, but really when it really, really clicks is when you may have made that mistake, or you may have done that thing that was right, and then you attend the lesson, and then you're like, oh yes, now I really get it, right? So very appreciated, Paul. Yeah, exactly. You learn the hard way. That's what it is, exactly. So anyway, so do and don'ts number 5. So don't hope for the best. Instead, pre-plan and stick to it. So what does that mean? Again, let's look at the facts. Hoping is a human emotion that becomes especially disruptive when trades fail, as it generates an unconscious need for hope. So what's the danger? Well, the rise of hope could produce reasons and excuses for us to break sensible trading rules that at that particular time when you are breaking the rules, they actually feel reasonable. I mean, I'm sure that some of you, if you have traded for a while, I think this probably happens to everybody who has learned to trade sometime in their life. There are times where you may have taken a trade, and then when you review it, you lost money on the trade, and you started wondering, why did I even trade? Why did I even take in that trade? That trade was nonsense. But guess what? The moment you executed that trade, it made sense. So what's going on? Again, is that, subconscious mind, human emotions, and hoping is a big one. Is that making sense? And the problem is that it's happening behind the scenes, and you need to develop certain level of expertise, experience through practice to have that conscious mind to control the unconscious, things going on in that other side of the brain, if you wish. Okay. So what's the solution? Well, make sure that you always define your entries and exits and quantities and further management rules before you place any order. And once you place an order in your platform, make sure you are not doing anything manually. Make sure you allow your platform to execute based on your trading plan while you may observe it from the sidelines. Again, trading technology is available nowadays. Platforms are programmable. You have bracket orders in most trading systems where you can predefine entries and stops and profit-taking orders as well. So you could basically, once you have planned all the components of your trades, you can just let the platform to execute it. And remember, platforms don't hope. They are a piece of software. They are not human. And therefore, there is no risk of falling into the trap of human emotions. So let me give you an example, okay, of what not to do and then what to do. So let's begin with what not to do with the euro in a 5-minute time frame. Okay, so let's say you are this particular trader and you identify that there is red. So, when the euro comes to the red, you understand it's gonna fall. So, you're gonna take the trade short. Okay, taking this trade short based on this particular methodology will make a lot of sense. Okay, but the key word, which would be wrong in this case, is that this trader, when looking at the chart, even though this trader has the right tools to trade, this trader is hoping that it will fall. In other words, this trader has no contingency plan for what if it goes up. Okay, that trader is only thinking it's gonna fall. I'm hoping it's gonna fall, so I'm just gonna short there. So let's say the trader does it, and the trader is right. So when the euro comes to the red, it falls, right? Congratulations. So how do you feel now? Well, you feel powerful. So what could you do? You could say, you know what? I'm gonna buy again. Now it's coming to the green, so I'm gonna buy, and I will hope it will rise. Okay, so the expectation now is that when it comes here, it's gonna go up. And again, the expectation is valid based on this particular trading methodology. Okay, but the problem again is the hope. There is no plan for what if it doesn't go up? What if it keeps falling, right? So, let's say it went up. So from here, that was the beginning part of the move, it went all the way up. So congratulations. Okay, but what happens now? Now you got 2 winners in a row. You feel you're invincible. Okay, and now that particular currency, the euro, is coming again to the green. And based on the trading methodology, you're expecting it to go all the way to the red, right? Which again, based on the methodology, makes sense. But the problem is that, again, we got hope. So what could happen now? Well, what could happen is that this time it may not work and it went all the way down. Okay, and what are you doing now? Well, you're still hoping. Please come back, please come back, please come back. And what happened? You really hurt yourself very, very badly. And even though out of 3 trades, you got 2 profitable trades, you actually ended up losing money, and big one. And not only money, probably you are losing confidence. Or maybe you have a different mindset, and instead of losing confidence, what's happening now is that you are developing now this revenge mode on how to trade, where now you're looking for revenge. And remember, guys, who is bigger, the market or our account? Well, I guess the answer is obvious, right? So we gotta be respectful. But again, when you open the door for hope, okay, you may open the door for a cascade of human emotions that kick in this cascade effect, if you wish, and this is the recipe to really, really get into a problematic situation. Okay. Yeah, Paul, you take too many trades, get overconfidence, and you're watching your loss get bigger. Yes, exactly. Okay, and again, and if these sort of situations have happened to you, it's okay. What's important is to learn the lesson and rectify to do it better. So how would it be to do it better? What to do it better is, again, look at the first trade, same chart, same situation. But now, instead of a hopeful trader, we are talking about professional trader that pre-plans and sticks to it. So what would you do? Well, I'm on a short with a stop and a profit exit. So how would that be? My entry short will be in the red. If it goes above the red, I will have a stop. And if it drops, I will exit for a profit. So let's see what happened. Well, the trade worked well. We collected a profit on the drop. Okay, so it went from the red all the way to the target. Congratulations, you made a profit. So what do you do now? Well, now you plan on the second trade, but again, no hope. Instead of hope, you have a plan. And what is the plan? The plan is to buy when it gets to the green. And if I'm wrong, I'm going to have a stop below. And if I'm right, I'm going to collect my profits when it gets to the red. Okay, or again, any other methodology you may use. Okay, but again, I'm using this particular approach for this lesson. So what would happen? Well, again, congratulations. It went up. So you reach the red, and therefore you made a profit. So what do you do now? Collected the profit, ready to plan trade number 3. And what do you do again? No hope. Pre-plan and stick to it. So what do you do? Plan for the entry, plan for the stop, and plan for the target. And then what? Well, as we know, the trade went against us. So when the trade went against us, what happened? We got stopped out. And when we got stopped out, we lost. But how much we lost? We lost this little bit while we made this bit, and we also made this bit on the way down. So look at the size of the bars, and even though my drawing may not be perfectly precise, but you get the point. You got 2 wins that clearly surpass the size of the tiny loss that was collected, and therefore this trader, thanks to a professional approach to trading, pre-planning your trade and sticking to the plan, this trader ended up profitable overall, where the other trader taking the same trades lost money because the first trader was hoping. So don't hope. Okay, that's the lesson. Let's keep going. Do's and don'ts number 6. Okay, and I need to accelerate a little bit in the presentation because I'm noticing that I am a little delayed. So don't act randomly. Instead, always be mechanical. So why is that? Fact, most traders use different techniques that often depend on their perception and interpretation of a specific set of market conditions. So what's the danger of that? Perceptions and interpretations are always add subjectivity, and therefore variability in the actions taken, making them arbitrary or even random. So what's the solution? Well, again, keyword mechanical. Mechanical actions paired with relentless discipline is the formula that produces that consistency. Where those actions are better defined by an effective trading technology, we remove the human component out of the process. So the rules and the action should be defined by technology, removing the human component out of the process. And when we need to be human is when being disciplined to apply those rules. Is that making sense? Let me give you an example. So here in the example of the left, let's pretend a trader wants to trade the euro using MACD. Nothing wrong with that. Let's say we have another trader willing to trade the euro using stochastics. Nothing wrong with that. Let's say we have a trader willing to trade the euro using Bollinger Bands. Nothing wrong with that. Let's say we have a trader using Fibonacci retracement lines. Nothing wrong with that. Using moving averages. Nothing wrong with that. Using on-field orders. Nothing wrong with that. But what would happen if every single trade you take, you use a different method, right? What if you were to mix all those different techniques depending on how you feel, right? So if you were to act randomly, okay, you would end up in trouble, even though all of those techniques utilized in a specific manner could be, could be producing certain advantages in the marketplace and certainly could be producing certain profits. If you keep mixing it just based on how you feel in a totally random manner, well, you may end up using powerful tools that end up nowhere. Where the fact is that, if you were to use a specific method where you have done your homework, you have done your back test, you know what is your quantifiable edge, you act only based on this mechanical approach, you act following the rules with the discipline. You get my point, isn't it? So do's and don'ts, number 7. Let me see. Jolanta, I feel like you know my trading history. Yeah, I understand your point, my friend. Paul, lesson learned, never take action without a rule. Exactly. So do's and don'ts, number 7. Don't act recklessly. Instead, be disciplined. Why is that? So what's the fact? Human emotions are often the cause for non-sensible action, despite feeling genuinely sensible when those actions are taken. So what's the danger of this? Well, the financial markets, which are much larger than us, should be respected at all times. And acting recklessly is a way for breaking this respect and opening up the door to making serious mistakes. So what's the solution? Again, impeccable trading discipline is not only a show of market respect, but also of a trader that respects themselves and their funds. If you do not take care of your capital, if you don't mind me to use a little bit of a strong word here, if you do not take care of your capital with how you trade, you don't even deserve to make money, right? It's kind of like, I don't know how to call it. It's kind of like a universal law of the universe, if you wish. You need to show respect to the markets. You need to respect yourself and your funds in order to put yourself in a position where some profits could be made, okay? So again, acting recklessly is not the way. Let me show you an example. For example, this trader here, okay, identifies this green area, decides, you know what, when the yen comes to this green area, I'm gonna buy expecting it to go up. Again, based on the trading, on this trading methodology, it makes a lot of sense. This trader actually uses a stop, says, you know what, my stop is gonna be 7 pips below. So this trader has some understanding of how to trade, some understanding of risk management, okay? But now, when the market comes and goes through the green, the green price range and hits the stop, now that trader that lost 7 pips now switches to trading revenge mode. So it's revenge time. So what this trader starts thinking is, okay, I will buy again with the next green area, but now I'm gonna double my size. I want my money back. I'm gonna double my size, right? That's reckless. Again, why would you do this, right? What's the reason? The only reason to do that is need for revenge, right? The market is doing its thing. If you didn't trade it that day, the market would have done the same thing that if you had traded that day. So, switching your mode from discipline to revenge time, it's really our choice. It's not the market pushing us to do that. It's just a choice, right? And many times that choice is coming from human emotions that have us act recklessly. Okay, so let's say now, the market gets to the green, and let's say it goes through again, right? So it went through both of those price ranges. In other words, you lost twice in a row. But the second time you lost double because your size was double. So even though your stop was 7 pips away, you lost 14. So 14 and 7 is 21 pips of loss at this moment in time. And you may say, you know what? That's it. No trading for me. I'm just going to look at the market. I'm just going to observe from the sidelines. I'm not trading anymore. And what happens? So now, as you're observing, the market is giving you an opportunity to short with a new red price range that just formed. But since you just said, you know, I'm not going to take it, okay, you do nothing, okay? The right action to be taken would be when this market comes to the red, short and expect it to fall. That would be the right action. But again, since, you know, you got upset with the market after your revenge time, you know, you decided, I'm not going to touch it today. So what happens now? Trading opportunity is identified, but you will not execute it because you concluded the market wants to hurt you. Sure thing, the market came to where the red price range was, and from there the market fell. And how do you feel now? You missed the entry. The trade produced 22 pips of profit. You missed it. So what do you say now? Well, now you say, you know what? Next time I'm going to triple my size to recover, right? So all of these will be an example of reckless action, okay, which we should never, never, ever open that door, okay? The right way to do it would be, hey, okay, I'm going to take my entry with 7 pips below. Hey, I got stopped out. I lost 7. Okay, let's do it again. My trade plan says that it's okay for me to take the trade. I'll do it. I'll manage my risk. Use a stop, 7 pips below. Oh, I got stopped out again. Okay, well, that's trading. Let's see if the market gives me another opportunity. I will wait patiently. Here we go. I got an opportunity. So let's plan for a short. I will use my normal size and impeccable professional discipline. Let's go for it. Here we go. That was my entry. That's my nice profit. I made 22 pips. I made 22 pips and I lost 7 and 7. That's 14 negative. So I am up, but sorry for that. I am up by 8 pips net. Even though 2 out of 3 trades were losses, I made profit. Why? Because I am disciplined. Okay? So important lesson, guys. Important lesson. As Paul said, never take action without a rule, and then of course follow the rule with discipline. Number 8, don't be overconfident. Instead, be humble and grateful for your trades. So why is that? Well, confidence is needed to be able to act timely, which is critical in trading. You have to buy at the right time, you have to sell at the right time. But what's the danger? Well, the danger is that there is a fine line between a healthy level of confidence and overconfidence, which opens up the door to major emotions, thus trading like the market owes us something and therefore ignoring objective market information. So what's the solution? Well, embrace this simple truth. The market does not owe us anything. Even if you didn't trade that day, the market would still do the same. So no matter our level of confidence, we should always be appreciative for all profits collected. Now, this is important. You should be appreciative of your profits only if you produce profits by applying a rule-based process. If you made profits out of luck, well, be happy, but you should not appreciate those profits because they didn't come to you out of using the right action. Is that making sense? You just got lucky, okay? Which could happen too. But really, the goal is to produce consistency and therefore not to rely on luck. So here's an example. So we have the US dollar, Sing dollar showing a very nice room between the red up here and the green below. There is a nice amount of space in between, okay, opening up for potential nice profits to going long. So what would you do? Well, maybe you decide, okay, so let's go long, okay? And the moment when this US dollar, Sing dollar went in and the market went up, this is exactly that time, okay? This is when it went in and from there it went up, okay? So now what was your expectation? Your expectation was to reach up here. That was the expectation, okay? But what's the reality? After you enter the trade in this candle, okay, what happened? New red appeared on your computer screen, right? Which you didn't like that because now it means that instead of selling at the higher price, you should be selling at a lower price, which is gonna cap your profit. So that is not gonna make you happy. But if that's your methodology and those are your rules, you should act on it, isn't it? We talked about discipline. So you would, plan to sell where that new red color showed up, which is unfortunate, but is what it is. Okay, and as the market came back up with this little move up here, you would have reached that red price and you are out of the trade for such a tiny, tiny profit, which probably makes you feel like, oh my God, I wasted my time, right? But what's worse? Well, what's worse is not that you got out here. What's worse is that after you got out, the market went all the way to where your target was, right? So if this happens to you, how do you feel, right? Here's the question. Just think about it for a second. So how do you feel if this happens to you? Should you feel upset? Should you feel that you need to change your trading methodology? Or should you feel grateful, right? Because in the end, the profit you collected is not out of luck. It's out of your methodology, whatever that is. And the market didn't owe you anything. Is that making sense? So you apply your methodology with impeccable discipline. You know your methodology, thanks to your backtest, gave you an edge. And therefore, if you keep doing it, you make money. So even though you missed on some profits today, that tiny profit that you collected, even though it's tiny, you should be grateful for it. It's like you are a fisherman. You went to fish that day. The weather was not too good. When you throw the net, you collected very little fish. But what's important? What's important is to go back home safely. Okay. And on top of that, you're bringing a little bit of fish. It's not too much, but it's something. So you know what? Be grateful. Okay. That would be a much more professional and positive way on how to think about trading. Number 9. Okay. We got two do's and don'ts to go, guys, and we'll conclude the session. So don't put all your eggs in one basket. Instead, be diversified. Why is that? So here's the fact. Most traders tend to prefer trading those markets they know better just because they sound familiar, hence bringing a greater level of comfort. Well, what's the danger? When a market selection is based on our comfort level, odds are that many of these trades will tend to be correlated and therefore adding excessive risk. So what's the solution? Well, trade different financial markets by applying the same trading methodology. Remember, if your methodology has you identify large market player and join them, buy when they buy, sell when they sell, you could apply this methodology to anything you trade, correct? So be open to apply your methodology to different markets in a way where dealing with these new markets or adding more non-correlated instruments to a portfolio does not become a problem. If you have developed 5 years of experience on a trading methodology, but that one only allows you to trade, let's say, the euro, you will never be able to be diversified. It would have been better to spend, 5 years was very exaggerated, but it would be better to spend, let's call it a few months practicing a certain methodology and make sure that when you practice it, you apply it to different markets to see if it works well in other markets too. Because then you will be able to diversify your portfolio, which reduces the risk, but also allows you to take multiple trades at the same time. And if you take multiple trades at the same time, you actually open the door to make more profits while you have reduced the risk. This could be useful. So take a look at Litecoin. Take a look at Ethereum. Take a look at Bitcoin. On the right, take a look at the Kiwi. Take a look at the Aussie. Take a look at the Euro. So what do you notice? Take a look, right? All those cryptos are going in the same direction. Take a look at the currencies with the US dollar in the quote. They are all moving in the same direction. Not exactly the same, but very similar moves and similar timings. And this will add risk to your portfolio if you were to run trades in parallel. Okay, so again, maybe you were to add, crude oil. Maybe you were to add a cross pair that is moving in a completely different direction. Now you will add more diversification, and that could certainly help you in many, many ways. Last do and don'ts. We have 10, my friends. Don't be isolated. That's a big one. Instead, be part of something greater. Okay, do what you're doing, like today, joining FXStreet, right? Where you guys are commenting on the comments box. So why is that important? Okay, well, trading implies lots of your personal time devoted to the financial markets. So what's the danger? This personal time can be problematic as emotions, inexperience, and lack of accountability can easily lead to breaking the needed discipline. Hence, making mistakes without even being aware of them, which, and that's the worst part, which could further evolve into potential lifelong bad habits that you don't even know you have. Okay? We cannot be isolated. We need to be surrounded by people, ideally people that know more than us, because we can be guided to a different level. So share your trades with your trading friends, review their trades, be open to their feedback, be ready to give them yours in a powerful community. Take a look at an example and you will see the power of this. Just very, very simple comments. So for example, when I run some trading sessions, so before planning the trade, the traders in the room are making comments. So for example, here's a couple of extracts from a chat commentary. So Bojan says, consumer confidence in 10 minutes might move the S&P. So he's preparing something. Okay. Now, notice that the decision is not based on the consumer confidence. This is a warning that says, hey, let's go plan a trade to see if we'll have an opportunity or not, based on evidence. But he's warning other traders that there may be a trade. In other words, now you are not going to miss it. Maybe you didn't know consumer confidence was about to be reported. Or Lisa says, hey, NQ is looking stronger. Maybe someone was planning to trade the Dow Jones and the NQ, which is the NASDAQ, is looking stronger. So maybe Lisa was giving a nice tip in the sense that trading the NASDAQ may be a better choice, better odds because of relative strength. Priceless advices. So here we go. Everyone just remember this. Sitting on your hands is also trading. No need to force trades, bend rules, and break the plan. I mean, imagine that you are in a trading environment where instead of being isolated, you are connected online with other people and you are getting nervous because today, let's say it's a difficult trading day and you're like, oh my God, I want to take a trade, but I don't find a good trade. What do I do? What do I do? I'm tempted to take this one, but it's not meeting my rules. What do I do? What do I do? And next thing you know, the other members of your community are saying something like this. Hey, you know what? Sitting on your hands is also trading. So that's going to help you and motivate you to have the right actions. Don't be isolated. Confirming where the target should be, right? So John says, higher target on 60, okay? Andrea says higher. Brian says go higher. So maybe you were a little shy planning your target. Maybe the past 2 trades have been losses and you are a little scared. So you want to take small profits and take them quickly to kind of, feel better. But John, Andrea, and Brian are telling you, no, don't do that. Even Dirk is telling you it's a strong uptrend. You need to look at the high time frame for the target. So that would help you to maximize your profits and manage some fear effect that may motivate you to take a sooner target just because you are, impacted by what may have happened 2 trades ago. Is that making sense? So again, don't be isolated. Be surrounded by people because that accountability process, if you wish, will make you a better trader. Discussing what to do once in the trade. So Watson say, I was filled, right? So you got filled in a trade. Now you know more people are in the same trade as you. How do you feel? You'll feel more confident. If you are more confident, you will be more prone to follow your trade management rules. Now, Irving wants to follow the trade management rules, but he's undecided. He's confused. He says, 3 candle limit would be based on minute or 3 candle of entering the trade. And immediately someone in the group Bojan says, hey, Irving, it's on times H time frame, 3 to 5 candles, right? So now you get the answer. You're like, okay, yes, I know what to do now. I know how to manage my trade. So instead of getting a little bit out of focus, and it's like, oh, what do I do now? So the group, okay, it's kind of helping you. So don't be isolated when you trade. And this could be your friends. This could be a WhatsApp group. This could be, a Skype call with 2 of your trading buddies. Is that making sense? This could be a trading room. This could be anything, okay? Of course, with FXStreet, you have an ideal environment with a community. And I'm sure that many of you became friends of each other thanks to this, right? But it could be anything. The concept here is what's important, right? So collecting profits and celebrating together. Well, Geneva got filled at target 1, Andrea later reaches target 2. Brian said, well done, guys. So what is this going to do for you, right? Well, it's again building that confidence that is needed, right? Or maybe they took the trade and you were undecided and you were watching from the sidelines, but now you see your community taking the trades and making some money, and you're gonna be like, you know what? Next time I'm gonna practice myself. And let's say you are very, very new and you never traded in your life, and you're like, you know what? I'll take the trades with paper money, I'm going to use demo accounts to simulate this trade and practice, but at least you open the door to some practice instead of only theory, right? Why? Because you are part of a community and you get to see other traders, okay? Learning new things, maybe Andrea is talking about taxes. Maybe you get to learn something about, using other countries for your trading, or using other brokers for your trading. Maybe you learn some languages, adios compadres, okay? Well, very bad joke here. So surround yourself by like-minded traders that help you grow by empowering you the way you manage your emotions, driving you to act professionally with impeccable discipline while keeping you accountable to yourself. Okay, so that's why you don't want to be isolated and instead be part of something greater. Anyway, so guys, we reached the end of the do's and don'ts. Again, today was a very basic foundational lesson, even though it's critical, because if you were to improve some of those things, even if you were not to change your methodology, you should improve your trading results, right? So then if you work on both, improving your methodologies and your behaviors, your actions in the marketplace as a professional trader or investor, then you will end up in a much better position, okay? But hopefully today's session was useful to you guys, and I would love to see if anyone has any question. I know I have surpassed the time. In theory, this session was supposed to last for 45 minutes, and I just went for an hour. So, but I'm happy to take any question if you have, and if not, you can also use my email, jb@tradictive.com with double D, and I will be delighted to give you an answer. Just give me a little bit of time to reply those emails, but I'll be more than happy to take a look at what your questions are and provide you with answers, okay? Very good, fantastic. So it seems that it's all clear. I can see some comments, but basically it's all clear. Very good, guys. So thank you very, very much again for joining the session today. It's been my true pleasure to be your guide and your trainer in today's session. And I will see you in some future session, guys. And in the meantime, let's stay in touch. And you guys take care and be disciplined. Take care. Talk soon. Bye-bye, everyone.